Over the last decade, and especially after COVID, SIPs have become one of the biggest structural stories in India's financial market. Just to give you an idea, in FY17, Indian investors contributed around 43,900 crores through SIP over the entire year. Fast forward to FY25 and that number has touched 3.5 lakh crore. That's an increase of more than 6.5 times in just 8 years. Monthly SIP flow has gone up from around 3,600 crore per month to now at 30,000 crore every single month, creating one of the most consistent sources of domestic capital in Indian stock market. A big reason behind this transformation has been increasing financial awareness. Campaigns like Mutual Fund Sahi Hai, the rise of discount brokers and fintech platform, digital KYC, finance content on YouTube and social media have made equity investing far more accessible than ever before. It's not just the amount of money that is growing. The number of investors have exploded as well. Active SIP accounts have grown from around 2.6 crore in 2019 to now at 10.5 crore. That's nearly 4 times growth in last 6 years. Every month, lakhs of new investors continue to begin their investment journey through SIPs. In many ways, SIP is no longer just an investment product. It has become a habit, a monthly financial discipline, almost the default way of investing for an entire generation of Indians. But over the last year or so, an interesting debate has started to emerge. Many investors who started their SIPs during the last 2 or 3 years were expecting good return on investment. However, depending on the fund category they choose, many investors are having either muted return or some of them are even facing their portfolios in red. Naturally, this has led to a fundamental question. Is SIP a bad investment strategy? Is it something designed to benefit the mutual fund industry in India at the cost of investors' money? Or is it just another example of investors losing patience and judging a long-term strategy over a very short time frame? So in this video, we'll analyze both arguments in favor and against SIP investment in India. And then I'll share my own viewpoint on whether SIP is a good strategy or not. Alright, let's get started. If you ask any experienced investor, what is the hardest part of investing? Most of them won't say stock selection. They will say controlling your emotion. Think about how most investors behave. When markets are making new high, confidence is at its peak. Everyone wants to invest more because they feel the market will continue to go up. But the moment markets correct by 15-20%, that confidence suddenly disappears. Investors become fearful. They postpone investment or even redeem their existing holding. In other words, people naturally tend to buy high and sell low. The exact opposite of what successful investing requires. Also, investors move funds into risky investments during markets high and move to safety in cash or low-yielding assets after market crash. SIP solved this biggest problem in investing. Not market volatility, but human behavior. Instead of asking you to predict whether today is the right day to invest, SIP removed that decision. Every month, irrespective of whether the market is rising or falling, a fixed amount gets invested automatically. This simple automation removes one of the biggest enemies of long-term wealth creation. That is our own behavior. In fact, there are reports that suggest that the returns earned by investors are often lower than the returns generated by the fund itself because investors chase performance. They tend to invest in funds that outperformed in the last 6 months to 1 year. But when the same fund underperforms in the future, they panic sell and switch to another fund. Basically, investors lack discipline. They simply chase performance. In other words, behavior destroys more wealth than bad fund selection. SIP attempt to eliminate exactly this problem. Then second argument in favor of SIP is majority of people in India do not have lump sum to invest. They receive a monthly salary, they save every month. So instead of waiting to accumulate a large corpus or trying to guess the perfect market entry point, SIP allows investors to invest their money. Then third strong argument is SIP builds the habit of saving. Before you can become a successful investor, you first need to become a consistent saver. And this is where SIP has made a meaningful difference. For most salaried individuals, money follows a very simple cycle. Salaries get credited, expenses happens, and whatever is left at the end of the month is treated as saving. The problem is that for many people, nothing is left towards the end of the month. SIP flip this equation. Since SIP investments happens automatically, usually within a few days of receiving your salary, so instead of spending everything, SIP forces you to spend only what is left after investing. And this saving habit can make an enormous difference to wealth creation. So the biggest argument in favor of SIP has never been that it generates the highest possible return. The biggest argument is that it gives ordinary investors a process that they can realistically follow for next 20-30 years. Now let's look at the counter argument. While SIP has several advantages, critics argue that the strategy has one major flaw. It assumes that over time you will get enough opportunity to buy the market at both high and low prices. But what if the assumption is no longer true? See, the basic idea behind SIP is simple. Every month you invest a fixed amount irrespective of market condition. When market fall, your fixed investment buys more unit. When market rise, you buys fewer unit. Over time, this is supposed to reduce your average purchase cost. But critics argue that this only works if market actually experience meaningful correction. And that's where Indian market over the last 5 or 6 years has looked very different. There's a very interesting valuation index of ICICI Prudential that shows green bar to invest in equity, yellow when valuations are high and they are neutral on equity, orange when valuations are even higher and they suggest moving money to debt, and red when valuations are extremely high and they suggest booking profit. There was a phase during 2010 to 17 when valuations were mostly fair and it indicated investment in equity. Then during COVID correction, it was again in green. However, since then, it kept hovering in yellow zone and even went into orange and red zone. Recently, after a long time, it touched green zone during the March month correction. Basically, the argument is Indian markets have been trading at premium valuation. And the biggest reason is SIP flow. Every month, nearly 30,000 crore enters equity mutual fund through SIP alone. Add to that, money coming from employee provident fund, insurance companies, individual stock investors and family offices. Together, this has created a stable source of domestic liquidity. As a result, the valuation of Indian markets have remained elevated, especially the mid and small cap space. That looks quite expensive. Although, due to market consolidation in the last 2 years, valuations have become relatively better. But if you compare the valuations before COVID era, they are still elevated. And due to this massive liquidity with domestic institutions, every dip is bought. Hence, the market corrections have been shallow. Even when market correct by 10-15%, buyers quickly step in and the recovery happens within weeks or months. In fact, some critics even say that this SIP culture is giving an exit to FIs and promoters. Now, if market really stay cheap for long, then most of your monthly SIP installments are getting invested when valuations are already above historical average. And this brings us to the biggest criticism of SIP. SIP protects you from timing risk, but it does not protect you from valuation risk. In the context of Indian market especially. And since future returns are heavily influenced by valuation at which you invest, critics argue that investors should naturally expect lower returns going forward. In other words, SIP may still work exactly as designed, but if the market remains expensive for years, the returns generated by that SIP may not be as attractive as what investors have experienced historically. Basically, the argument against SIP is it has become a victim of its own success. Now that we have discussed both sides of the argument, let me share my viewpoint. So coming back to the original question, is SIP a bad investment strategy? Personally, I don't think so. In fact, if you ask me, SIP is probably one of the best financial habits that an ordinary investor can build. It forces you to save regularly, it keeps you invested, and most importantly, it removes the temptation of trying to time the stock market. But at the same time, I also don't think we should treat SIP as some magical formula that guarantee great returns. Today, many investors have started believing that an equity SIP will automatically generate 14%, 15% annual return over the long term. But I think that's an expectation we need to revisit. If the market remains expensive for a long period of time, your returns may also end up being lower than what investors enjoyed over the last decade. And that's probably the biggest takeaway from this video. SIP can protect you from your own emotions. It cannot protect you from expensive valuations. Now, does that mean you should stop your SIP every time the market looks expensive? Personally, I would not recommend that, because the moment you stop your SIP, you're making another assumption. that you will know exactly when to restart it, which is extremely difficult. In fact, a lot of people who wait for market corrections end up regretting, because by the time everyone agrees that the market has become attractive again, chances are a large part of that rally has already happened. Also, today the SIP book is around 30,000 crore. I believe that as more and more people continue to join the workforce and invest their money, this SIP book will continue to grow. India is one of the fastest growing economies in the world, and this growth is secular for next few decades. It means the earning growth for corporate India should continue to be in double digit for the next few decades. So for most investors, continuing the SIP still makes complete sense. The only thing I would change is my expectation. A better return expectation from SIP would be 10 to 12%. With this expectation in mind, your financial planning would have a better margin of safety. However, I would suggest that rather than being 100% invested in equities, you can keep some 10-15% cash that can be deployed at the time of correction. Think of your SIP as the base of your portfolio and market correction as opportunities to add on top of it. Market keeps giving opportunity every now and then. For example, the recent correction in March-April phase was a great opportunity to top up. So rather than panic selling or stopping your SIP, if you can utilize that correction to buy more, it can increase your overall return by another 2-3% in the long run. And one last point, don't expect immediate results from SIP. I think one of the biggest mistake investors make is opening their mutual fund app every day just to see the return. If the portfolio is flat or slightly negative, they begin questioning the entire strategy. But that's not how SIP was designed to work. The whole idea behind SIP is to benefit from multiple market cycles. A bull market, a correction, another recovery, and then another cycle. That process takes years, not months. So if I had to summarize my approach, it would be very simple. First, continue your SIP because consistency is far more important than trying to predict every market move. Second, don't build your financial plan assuming 15% equity return forever. Keep your expectation low. Third, if you have surplus money, don't deploy it all immediately. Keep around 10-15% available so that when markets give meaningful correction, you can invest more aggressively instead of panicking. Fourth, invest with a long-term horizon. Avoid checking your returns every few days. To me, that's probably a more balanced approach than either blindly trusting SIPs or trying to time every market move. Now I would love to know your thoughts. Do you think SIP is a good strategy or not? Let me know in the comments. If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.